This is the story of how the world accumulated $318 trillion in debt, and the surprising answer to a question that changes everything. If everyone owes money, who is actually owed? By the end of this video, you'll understand why your retirement account makes you a creditor to the government, why half of Japan's national debt is owned by its own central bank, and how a decision Richard Nixon made in 1971 created the conditions for unlimited debt expansion. The numbers are staggering, and the United States national debt currently sits at approximately $36 trillion, while adding roughly another trillion every 100 days. America is far from alone in this situation. According to the Institute of International Finance's February 2025 Global Debt Monitor, the planet's total debt reached $318 trillion by the end of 2024, which means the world owes more than 3 times what it produces in a year at 328% of global GDP. And that's when it gets interesting, because every single one of those dollars exists twice, once as a liability on someone's balance sheet and once as an asset on someone else's. Breaking down that $318 trillion figure reveals that not all debt gets created equal. Government debt accounts for $95.3 trillion, about 30% of the total, covering everything from US Treasury bonds to Japanese government securities to European sovereign debt. Corporate debt adds another $91.3 trillion, covering everything from Apple's corporate bonds to small business loans, while the financial sector itself owes $71.4 trillion, representing borrowing by banks and financial institutions. Household debt totals $60.1 trillion, which includes your mortgages, credit cards, student loans, and auto loans. What should grab your attention is the trajectory. 265% growth since 2000 means global debt has exploded from approximately $87 trillion to over $318 trillion in just 24 years. We've added over $230 trillion in less than a quarter century. 2 events turbocharged this expansion, and the first came with the 2008 financial crisis, when governments bailed out banks and stimulated economies, causing debt to GDP ratios to jump 19 percentage points. COVID-19 delivered the knockout punch. In 2020 alone, fiscal stimulus programs pushed global debt ratios up 28 percentage points in a single year, making it the largest peacetime surge since World War II. The International Monetary Fund noted that global debt reached $226 trillion in 2021, up from $255 trillion just before the pandemic, and we've added nearly $100 trillion since then. But here's the paradox that breaks most people's brains. If the world owes $318 trillion, there must be $318 trillion worth of assets sitting somewhere. Debt doesn't evaporate into thin air, and every IOU has a creditor on the other side waiting to collect. Zooming in on the United States reveals exactly how the global system works, because the ownership structure here tells the whole story. America's national debt stands at approximately $36.2 trillion as of February 2025, and the Treasury Department splits this into 2 categories: debt held by the public at about $28 to $29 trillion, and intra-governmental holdings of roughly $7.3 trillion. That second category is where things get weird, because it's money the government owes to itself. $2.8 trillion sits in the Social Security Trust Fund alone, held in special, non-marketable treasury securities. When workers pay FICA taxes and Social Security runs a surplus, that money gets invested in government IOUs and the Highway Trust Fund, the Military Retirement Fund, and federal employee retirement funds hold the rest. Right off the bat, about 20% of the national debt is circular, where the government owes money to its own trust funds. $4.4 trillion in treasury securities gets held by the Federal Reserve, accumulated during the quantitative easing programs we'll get to in a minute. These holdings peaked above $6 trillion during COVID, but have declined through quantitative tightening. And here's the kicker: the Fed remits its profits, including interest earned on those treasuries, back to the Treasury. This debt is largely cost-neutral for taxpayers. Foreign holders account for $8.5 trillion, about 24% of the debt, and Japan leads the pack at $1.06 trillion, followed by China at $759 billion. The United Kingdom holds $723 billion. Notice something? China's holdings have collapsed from over $1.3 trillion in 2013, steadily reducing their exposure to U.S. debt in a trend we'll come back to later. That leaves approximately $15 trillion held by domestic private investors, which is the largest category comprising mutual funds, pension funds, insurance companies, banks, state and local governments, corporations, and individual Americans holding savings bonds. This is money Americans owe to other Americans, or more precisely to the institutions managing American retirement savings. Add it all up and you get a surprising answer. America largely owes money to itself, its own citizens, and its own institutions. Understanding who is owed requires grasping one simple accounting truth that changes everything, which is that every debt instrument exists simultaneously as a liability and an asset. When the U-10S Treasury issues a $10,000 bond, two things happen at once. For the government, it creates a liability requiring repayment of $10,000 plus interest, while for the bondholder, it creates an asset worth $10,000 plus future interest payments. The transaction is a zero-sum exchange, where the government receives $10,000 in cash it can spend, and the investor receives a security worth $10,000 they can sell in secondary markets, hold for income, or pledge as collateral. Neither value disappears. This is why global debt doesn't net to zero in any meaningful economic sense. While the accounting balances perfectly, the distribution creates real relationships and power dynamics where governments and through them, taxpayers owe money, while bondholders, including pension funds, wealthy investors, and foreign governments are owed money. Interest payments transfer wealth from the former to the latter. $892 billion. That's what US interest payments reached in 2024, more than defense spending and 13% of federal outlays. Every penny flows to bondholders. Banks extend this principle through something called fractional reserve lending, and when a bank makes a $100,000 mortgage loan, it simultaneously creates a $100,000 deposit in the borrower's account. The bank's balance sheet shows both a $100,000 asset as the loan receivable and a $100,000 liability as the deposit, which means money is literally created through lending. Since March 2020, the Federal Reserve has set reserve requirements at 0%, making the traditional money multiplier concept largely obsolete, where banks are limited primarily by capital requirements and their assessment of creditworthy borrowers. Who are these mysterious creditors? The answer leads to institutions most Americans interact with regularly without realizing they're the nation's lenders. Pension funds hold trillions in government bonds because their obligation to pay future retirees requires stable, predictable assets. Japan's government pension investment fund, the world's largest at $1.87 trillion, allocates approximately 50% to bonds, while U.S. state and local public pensions hold $6.5 trillion in total assets, with roughly 22% in fixed income. When critics say future generations will pay for the debt, they're partly right, but those future generations will also inherit the assets in their 401(k)s and pension plans that hold those same bonds. Insurance companies are legally required to hold substantial bond portfolios to back policy obligations, and U.S. insurers alone hold $5.4 trillion in bonds, comprising 60% of their total invested assets. When you pay life insurance premiums, that money flows into Treasury securities, which means your insurer is a creditor to the federal government. The big three asset managers collectively manage over $24 trillion in assets, with significant portions in bond funds. BlackRock manages $10.5 trillion, Vanguard manages $9.3 to $11 trillion, and State Street manages $4.3 trillion. When you own shares in a target date retirement fund or total bond market index fund, you indirectly own pieces of government debt. Sovereign wealth funds represent government-owned investment pools, and Norway's government pension fund Global, the world's largest at $1.8 trillion, allocates approximately 30% to fixed income, which equals roughly $540 billion in bonds. This creates a circular system where governments lend to other governments, but central banks transform the debt landscape more dramatically than any other player. When the Federal Reserve conducts quantitative easing, it purchases Treasury securities from primary dealers, which are the 24 authorized financial institutions like JP Morgan and Goldman Sachs, and pays by crediting their reserve accounts. It's effectively creating new money with keystrokes. The timeline is remarkable, and QE1 ran from November 2008 to March 2010, adding $1.75 trillion to the Fed's balance sheet to stabilize the financial system. QE2 added $600 billion from November 2010 to June 2011, while QE3 was open-ended, adding over 1.5 trillion from September 2012 to October 2014. COVID changed everything. Starting March 2020, the Fed was purchasing 120 billion per month at peak, expanding its balance sheet from 4.2 trillion to 8.9 trillion. The Bank of Japan took this further than any central bank in history, 582 trillion yen, about $3.68 trillion, which equals approximately 50% of all Japanese government bonds, now sits on the BOJ's balance sheet. Half of Japan's government debt is owned by its own central bank. 4.3 trillion euros in securities for monetary policy purposes gets held by the European Central Bank's Eurosystem. When central banks purchase government debt, the debt doesn't disappear but transfers from private hands to the central bank's balance sheet. Since central banks remit profits to their treasuries, the net effect approximates what economists call debt monetization. Japan's situation is the extreme where half its government debt is effectively owed to itself. None of this would be possible under the old monetary system. And to understand why debt exploded, we need to go back to August 15, 1971. President Nixon addressed the nation from Camp David that evening, and with Fed Chairman Arthur Burns, Treasury Secretary John Connally, and future Fed Chair Paul Volcker present, Nixon announced the suspension of dollar-gold convertibility. The decision ended the Bretton Woods system that had anchored global finance since 1944. Nixon acted because US gold reserves had dwindled to just 10,000 metric tons, insufficient to back all the dollars in circulation at the official $35 per ounce rate. France and other nations were actively redeeming dollars for gold, threatening a bank run on Fort Knox, and the Nixon shock freed the dollar from its golden anchor. Under Bretton Woods, countries faced hard constraints where running deficits required gold outflows, and you couldn't just print more money without losing your gold reserves. Under fiat money currency, issuing governments face no mechanical limit on debt issuance in their own currency because they can always create more currency to service debts. Modern monetary theory proponent Stephanie Kelton argues the government can't run out of money and has the ability to create as much money as it needs. She's technically correct for currency issuing governments, and the United States can never involuntarily default on dollar-denominated debt. Austrian economists vehemently disagree with this optimism. Ludwig von Mises warned that fiat money carries within itself the germ of its own destruction, and the dollar's purchasing power has declined over 98% since 1971. Gold prices rose from $35 to over $3,000 per ounce, validating Austrian concerns about inflation eroding currency value. The debt explosion we've witnessed is directly traceable to this moment. When you remove the constraint of commodity backing, debt becomes limited only by political will and market confidence rather than physical reserves. Several recent developments suggest the debt system is entering a new phase. Rising interest rates have transformed debt servicing costs, and the Federal Reserve cut rates 100 basis points in late 2024, but after years near zero, the average interest rate on government debt has climbed substantially. Those $892 billion in interest payments in fiscal 2024 represent 3.1% of GDP, and the Congressional Budget Office projects interest costs will exceed all-time highs as a share of GDP every year through 2034. Foreign holders are reducing exposure, and Japan sold a record $61.9 billion in U.S. Treasuries in the third quarter of 2024, while China sold $51.3 billion in the same period, marking its second-largest quarterly reduction on record. China's holdings dropped from over $1.3 trillion in 2013 to $759 billion today. And meanwhile, central banks globally added 1,045 metric tons of gold in 2024, the third consecutive year above 1,000 tons, suggesting hedging against dollar-denominated debt. The debt ceiling drama continues, and after the 2023 crisis was resolved when Biden and McCarthy reached a deal on June 3rd, the ceiling was suspended until January 2025. When it reinstated at $36.1 trillion, Treasury began extraordinary measures again, and in July 2025, Congress passed what they called the One Big Beautiful Bill Act, raising the ceiling by $5 trillion to $41.1 trillion, the largest debt ceiling increase in American history. And in a historic shift, the Bank of Japan ended negative interest rates in March 2024 and abandoned yield curve control, marking the first rate hike since 2007. The paradox has a factual answer, where creditors hold debt as assets, but also a deeper political economic dimension worth considering. Debt creates wealth transfer because debtors must generate income to service obligations while creditors receive passive interest income. When U.S. interest payments reach $892 billion annually, that money flows to bondholders, including foreign governments, pension funds, insurance companies, and wealthy individuals with capital to invest. The bottom 50% of Americans own virtually no Treasury securities, and the benefits of government debt accrue primarily to capital owners. The concentration matters because BlackRock, Vanguard, and State Street collectively control over $24 trillion in assets, while the top 10 sovereign wealth funds exceed $10 trillion. A relatively small number of institutions hold much of the world's debt. Some debts are truly circular, and when the Federal Reserve holds $4.4 trillion in treasuries and remits profits to the Treasury, or when Social Security trust funds hold $2.8 trillion in government securities, the government essentially owes money to itself. Approximately 1/3 of U.S. debt falls into this category. Japan's situation is more extreme, where half its government debt is held by its own central bank. The $318 trillion question has an answer, but it reveals a system rather than a single creditor. Global debt represents a vast web of financial relationships where governments borrow from pension funds managing your retirement savings, from insurance companies backing your life policies, from sovereign wealth funds recycling oil revenues, from central banks creating reserves with keystrokes, and from foreign nations seeking safe assets. The debt is real, the interest payments are real, and the power dynamics are real. Every treasury bond sitting in a Japanese pension fund, every government security backing an insurance company's reserves, every I-bond in an American family's portfolio represents both sides of the ledger. The world's $318 trillion in debt is simultaneously $318 trillion in assets. The paradox dissolves when you recognize that debt isn't a hole in the ground, but a bridge between parties. The questions that matter aren't about whether the debt exists or who technically holds it, but rather who stands on which side of the bridge, who pays the tolls, and whether the bridge can bear the weight of another $1 trillion added every 100 days. Alexander Hamilton once said, "A national debt, if it is not excessive, will be to us a national blessing." Herbert Hoover countered with, "Blessed are the young, for they shall inherit the national debt." Both were right, because the young will inherit the debt, and they'll also inherit the assets. Whether those cancel out, or whether the interest payments flowing from workers to capital owners represent the largest wealth transfer mechanism in human history, remains the question. $318 trillion can't answer that question. But understanding who holds that debt and why is the first step to seeing the entire financial system for what it really is. Not a mystery, but a mechanism. And mechanisms can be changed.